This is Carson Block with Zer0es TV, and welcome to our first ever Armageddon special. I'm thrilled to be interviewing Hugh Hendry, a global macro investor for many years, now dabbling in it, I guess. But Hugh's got fantastic perspective on the risks that have been piling up, and I'd love to hear his thoughts as to really how much we should worry and how we should position. Hugh, thank you so much for being on, and it's great, but I'm bummed that this is the first time we've caught up, I think, since the whole COVID thing happened. So it's great to have you on. Thank you.
It's a pleasure to be here, and it feels like the old days because I've been I put a few thought pieces out on China. I've been reminiscing about my kind of macro positioning in 2011-12. I've been reminiscing about my China macro positioning in 2015, none of which worked. I mean, China is just the land of the happy credit people. Nothing ever goes wrong. I kind of get a rap for being a bit of a bear, and I'm a bit more sanguine about where markets are priced, and kind of have anticipation. I have expectation. I have desire for kind of like a 20% decline in equities, just to kind of make it a little bit safer to enter the water again.
Well, yeah, it's funny you bring up China. I mean, I know you were a bear on China for a while, and then you went long. But I remember seeing you debate Jim Chanos on China, and you were the bull side. But at the end of it, I mean, you were so overwhelmingly just negative on it as a society and in terms of its policy. There's this really ironic statement at the end that you made about just, it's really hard to believe that I'm long this place, but I am. And you were well positioned at that point. I mean, that actually, if I recall correctly, that was a good time to be long China. So, you've gotten that right.
Well, that would be 2015. So if I was to kind of give you the chronology, in, I want to say, the end of 2011, one could, and I want to say probably one can still continue to buy very either lowly rated or cheap risk, which has an immense capacity for convexity, which is to say for an explosive movement. And I was purchasing 5-year credit default swaps on profoundly financially and operationally leveraged Japanese companies. And Japanese because of the trading symbiosis, and Japanese because of the depth and magnitude of their capital markets for CDS. The Chinese have a preference for controlling this stuff in the manner that the Japanese have been a little bit more liberal with. And so a deeper pool, but playing off the catalyst of a China which could slow. And so the fascination, really, the timing is very critical to this because it was the end of the noughties, which coincided with the profound march forward, all those the pitter-patter of all those little peasants' feet as they left the villages and headed to the metropolis. Yeah, we'll never see such a leap like that in terms of prosperity, from zero to an average of $10,000 per capita, and everything that it inferred, and everyone felt happy. In many respects, the proletariat was being screwed because the immense leap in the productivity from taking them from these pools of inactivity in the villages into these modern factories in the metropolis was astonishing, and they got a pittance of that increment. But they were happy because it was way greater than what the villages and their forefathers had experienced. And all of that, and the building out of villages in the sky, cities in the sky, really kind of concluded in that 2010, 2012 window where GDP really should have started to the growth rate really should have pared back. And that's where there was a kind of, it was like there was GDP growth came to be seen as a virility test. It came to be seen as an endorsement of the CCP. And that's where Chinese growth, whilst it continued, and okay, at a slightly less ferocious clip, but still relative to the rest of the world, Chinese growth, I think, contributed, I want to say, at least a third to global GDP growth in the ensuing decade. And it just kind of wasn't the same. It was GDP growth. I want to say GDP growth at the expense of prosperity, at the expense of wealth, which is to say that you can increase the gross domestic product by building more things. But if those things have a zero net present value, or worse, a negative net present value, and if there's no mechanism for the disclosure of such negativity, then you have GDP growth, but you don't have the same or any increment in wealth, which is kind of where China has been. That kind of requires a whole dentist chair and kit of funny wheezes. And the wheeze initially, and I kicked myself. I was a hedge fund macro manager. And I was tweeting today, I was saying, hey, we had no Brevin Howard before 2002. That to my Brevin, I know Alan hates being kind of name-checked, was the emergence of macro as we know it today. And China, since the emergence of Alan et al., has had no drama, as I was purporting to, but actually at the beginning of that period, so with the great financial crisis and everything, CDO and Lehman's et al., China stopped the dirty kind of appreciation, dirty in the sense that it's controlled and manufactured and it's at a pace which is dictated by bureaucrats rather than market forces. And they suspended that for almost 2 years, and then let the currency again be pulled almost like gravity by the gravitational forces of the market to a higher level vis-a-vis the dollar. They were terrified about doing anything to endanger Chinese GDP, that the crawl higher in the peg, in the CNY versus the US dollar, it had no volatility. And so this was, you had US quantitative easing introduced, you had interest rates on the floor, almost at zero. And for the first 2 years of that period, you had a dollar which declined. And you had this desire to keep pushing GDP growth on the mainland, and without wealth creation requiring wheezes. And so you had this wheeze where the low vol brought $1 trillion of capital into that carry. It was positive carry. Your liability was devalue, i.e. your liability was the dollar versus the renminbi. And via, if you remember this well, the nefarious means of double invoicing and gold trading and whatever, in terms of turning this red cabbage, these dollars into a currency that you could actually use for speculative purposes on the mainland. So turning it into not CNY but CNH for purchase of goods and for speculation domestically was profound, and was a profound $1 trillion boost to that GDP growth projection. At the end of 2014, they kind of began to recognize that, like Houston, we got $1 trillion of leverage in the offshore market. How did that happen? And so they went, hey, no problem, we'll just raise the vol. And so they went, hey, a little coup de volatility. And the market just went, what? We've got $1 trillion of risk here, which is underwritten on a vol of, let's call it 3. And you're telling us the vol's going to be more like 7, 8. Hold on a second. And the thing went, boom, 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 boom. The CNY lost 20% and devalued 20% over the course of the next 2 years. So that was a leverage vol event, really the only Chinese leverage vol event of the modern macro era. But it was offshore. And once we got to about 720, 730, the trade had unwound, and we just went back into this kind of mind-numbing existence of flat domestic yield curves where you can lend with no tears until they tell me that something now is happening. When I read the financial press, they keep mentioning this thing called Evergrande.
Well, so yeah, listen, in terms of Armageddon, that brings us to one of the things that I want to talk about. So if you look at China, you've got Evergrande, you've got this significant energy shortage, which ironically, from what we can tell, is being really downplayed in the Chinese press. So it's got to be bad. In Europe, there's an energy shortage. And in the US, we're in the process of like shooting ourselves in the foot again. We might default. All of these things are converging more or less at the same time. And maybe the default, a US default would be the difference between markets really, taking a dump and things being fairly stable, or maybe the markets in the world kind of shrug off a US default. But I'm curious, first at a high level, as to how risky you think the overall situation is given these and perhaps other factors I didn't mention. And then maybe we go in, region by region, talking about China with Evergrande and energy and, US. And also the final thing that I do want to talk about a little bit. I don't know if you read this op-ed by a guy named Robert Kagan that ran in the Washington Post last week. It was pretty lengthy, but where he's talking about how he believes that Trump will be the 2024 Republican candidate and that Republican legislatures will likely be in a position to override the vote if the votes were to go for the Democrat, and that if that happens, we'd have a constitutional crisis. And, when I think of that as from my chair in America, I feel like on a long-term basis, we could really be talking about political dissolution. But, after we discuss the near-term potential Armageddon scenarios, would love to talk about that as well.
That dovetails nicely with my intro, and I was a bit of pushback. I like to annoy people, I guess, to be controversial, whatever. And I was saying, hey, I'm a little bit more sanguine about wherever markets are priced. People want to dismiss it as irrational, and I can see a lot of rationality, but it's a rationality whereby cold-hearted, cold-calculating private sector individuals are willingly accepting lower and lower returns as a playoff with regard to the volume and the metric of risk that they're willing to expose themselves, their reputation, and their career. So I believe there was a permanent loss of GDP globally arising from the great financial crisis of 2009, which is to say that the prevailing trends of GDP were never reestablished, that we at best rallied into where that trend line was, but we never had an oscillation that would take us above and therefore would support the continuation of that trend. That trend has largely it's gone to a gradient of zero at best. And so the difference, if you will, there's a triangle, which is the lost GDP, permanent loss of GDP. There is a profound dislike in the economic profession and community to use the word depression. It's regarded as it's just no longer relevant to our world. And I see that as another example of the conceit of modernism. I want to say that we have that permanent loss of GDP deserves the moniker of depression, mild depression, but depression. And in a depressionary environment, the risk preferences of investors change, and they go to the floor. They reset their risk preference. The risk preferences in that mortgage CDO market 2004, 5, 6 was, I'm divorced. I've been in prison. I'm a bit depressed. I'm taking pills. In fact, I'm shut up, just take the money. We're very tolerant of risk. And we that was one end of the spectrum. And here we are today for all this silly and ridiculous commentary about growth rates and the monetary base. Banks ain't lending. JP Morgan only 2 quarters of the results ago were saying, could you stop please sending us more deposits? So that's we're in a strange one. Now, the manifestation of that in capital markets has been any security which is deemed to be riskless. And I know these are all, these make profound and sometimes silly assumptions, but the riskless nature of the US Treasury market, and we're going to pursue that. But US Treasuries are deemed to be riskless in a manner that German 10-year are riskless. And as we've seen with German, you traded with negative yields, which is to say, again, owing to the risk preferences, calculating rational investors are willing to accept negative returns, but you're choosing to define the negativity of their return. And I want to say that with the alien body invasion of COVID and this profoundly shocking devaluation in GDP again, this growth shock, it was very revelatory in that, so in an environment where GDP crashed, you had the prima facie evidence of a coterie of businesses whose sales and profits remained intact, and for some, business actually expanded in the face of unprecedented sharp economic contraction. And so they, of course, they were gaining, and it just cemented their reputation as being riskless securities as well. And the first manifestation of that would have been Apple becoming the first $1 trillion stock. And today it's a $3 trillion stock. And why could it not be a $5 trillion stock? Because we are defining priceless. What is the price that you would purport to a Michelangelo painting? It's kind of something it's higher than the last price, kind of is where we are. And so that coterie of equities, I think now, probably no more than 20 stocks, and probably accounts for almost 75% of global stock market valuation. Everything else, which is so the 90 odd percent of the names. If we look at the FTSE not the All-Share, the FTSE 100, the largest market capitalized stocks in the UK, the prevailing price today is the same as the level which prevailed at the turn of the century, 21 years ago. And China, despite the growth of, just to clock out, two observation points, but the Shanghai A, which is again to extract what could be deemed what was deemed riskless before the common prosperity drive, the social media platforms. Without them in the index, the Shanghai A is at the same level that prevailed 16 years ago. And of course, if we look at all the household names from Ford to go through all the sectors, Boeing, etc., you can find some of General Electric. You can see that today's prevailing price takes you not just to the beginning of the century, but continue into the 1990s and the early 1990s. So it's a market. So really, anything with the shadow of risk is profoundly lowly rated. I won't say cheap, because it does have the obstacle of risk to overcome. And then there's this tiny coterie of everything else, which accounts for of where markets are. So that's a long way of saying you're very right to be worried about a default. A default would essentially just stab. It would be it'd be killing it would be daylight on the coffin of the vampire of risklessness. If you were to attack that assumption of risklessness, the game is over. There we are. If the US defaults, the game is over. Did you need me to speak for 20 minutes for everyone to realize that? Probably
I guess counterpoint to that, US has been on the brink of doing this several times. And if the US did it this time, I mean, the reality is that the US government would eventually make the payments, would pay accrued interest. Is the market really going to care?
Are you saying that there is a technical default, but then it is kind of smoothed over? Or you're saying that when push comes to shove, as I understand it, correct me if I'm wrong, you do not require bipartisan support. I mean, there are enough Democrats to push this thing forward, no?
Well, there are, so if you go to budget reconciliation, and I'm speaking out of school here a little bit because I'm not an expert in this area, you can do it budget reconciliation with a simple majority, which you've got 50 Democrats, and then you get the vice president casting the tie-breaking vote. But I think one of the issues that the Democrats are facing is I believe there's a limit as to how often you can use budget reconciliation. I might be totally wrong on this, but the issue is that they have a lot of other priorities that they are going to have to pushed through reconciliation. So it's unclear that they would be able to get, if I'm correct, that there's a limit as to how often they may employ this. I think that's one of the issues, but they are saying now that they might try to get this through reconciliation. But I guess even if we put aside the timing, maybe, the Democrats don't do it, or they can't do it because Manchin and or Sinema don't come on side. Eventually it'll happen. The reason why I think this might not, or I can see a counter argument to this really spooking markets, is that nobody would be saying, hey, the United States doesn't have the capacity to pay to service the debt. I mean, from a financial and economic perspective, of course the United States does. It's just deciding not to for its own internal political dysfunctions. But that dysfunction is presumably priced into markets because it's not a new dysfunction. That's a counter argument. I'm curious as to your thoughts on that. But again, maybe with the other things that are going on at the same time, it's impossible to look at this just in isolation.
Well, like I prefaced, my modus operandi is to be sanguine. And, who wants to be the guys saying, I fell for this the last time I went short, I sold everything, I was convinced they were going to default. Oh, what an idiot. You don't want to be the guy who does that again and again and again. For sure, crikey, for sure, they can't be that dumb, can they? The Kagan piece, funnily enough, it's today, it has found itself subject to further op-ed comments from others. So Martin Wolf's in the Financial Times and referring to it. So I missed it the first time around. I took it via Martin, and it is profoundly despairing. It's profoundly despairing, the notion that Trump would seem to be in a very strong, I can't say commanding, but a very strong position as we look ahead to another election and the consequences of that. And it is disturbing for many reasons, which are not necessarily about the pricing of capital markets. But for capital markets, I have long sought to add into the definition of inflation being this, this Friedman monetary phenomenon. I am not an active risk taker today in capital markets. Sort of with Trump transparency, I am doing other things. But if I were, I would be looking for the point to would I be receiving? I'd be betting on so what happens is I've been in this cycle so many times where all of the financial media on their front page tell you that we have inflation. When we don't, they confuse the rise in relative prices. And when it's not supported by the creation of money by private sector banks via their function of making loans into the economy, then you find that these higher energy prices, which are taking down industry and creating shortages in the UK as people panic, these high prices tend to dictate that people have to cut back consumption elsewhere, and therefore, whilst you get these bumps, again, you end up with central banks who bought the hype, who bought the kind of democratic pressure from an ignorance of how the thing truly works and raised their rates. Remember the ECB raised rates in the summer of 2008. These people, their form is poor. And not only that, they did it again in 2011. I mean, they're really, really suspect. And what you find, actually, when you're looking at receiving rates, is you're looking for that point that nothing competes with the market's imagination. And it tends, the imagination for the dots, if you will, tends to be absolutely at its zenith when it coincides with the bank actually committing and raising rates. And that's the point where I kind of want to be in Eurodollar futures and buying, December 22s and 23s, if you will. So there we are just now, and the media is dominated by inflation articles, and I'm dismissing it because I want to add that inflation, the potency of inflation, really is a function of babble. It's psychology. And it's really where, if you introduce anarchy, so for me, we keep going back to the Weimar Republic, and the lack of fiscal discipline. They threw everything. They ran a budget deficit of 25% of GDP. And we used to read that and go, wow, they were so nutty, What is the US? What's the US deficit to GDP? It's not 25, but, it's knocking on the door. It's in the kind of the crazy nutty neighborhood. And yet, nothing's happening. To circle back to Kagan and the despair that I have when I read those pieces, if anything was going to introduce profound degrees of future inflation, it would be a form of political anarchy, where I hate you and you hate me, and we don't see two human beings, we just see enemies. And that corruption of the political system, that seeps into the capital markets, and people just desist and they say, I'm stepping out, and I'm off to New Zealand or whatever. That's the concern that I have. So.
Right. Well, when I think about that, the 24 scenario that Kagan lays out, I suspect there's a difference. And I'm really looking at this, I guess, maybe through my own filter and biases, but I feel like there would be a difference if Trump becomes president and the red states had kind of moved the goalpost by making voting harder and, disadvantaging minorities who want to get to the polls. I feel like that would be grudgingly accepted in the blue states. But if you had a situation in which a legislature has authorized itself to overturn votes on the pretext that there's fraud, or you have a Secretary of State does the opposite of Brad Raffensperger, but just caves into partisan pressure and says, well, I know what the returns are, but no, this is fraudulent. I'm certifying that Trump won. That to me is a different scenario. And that is when I think, blue states start thinking like, what's the point? And so one of the things, if I'm really conjuring up nightmare scenarios, one of the things that occurs to me is, well, what if California, New York, and some of the other blue states enacted laws that said we are going to prohibit our citizens from paying income tax to the federal government because we don't recognize the government as legitimate. So it's not just this interesting question of constitutional law and how would the Supreme Court rule. It could become, I think the 21st century version of the Civil War is really, it's really fiscal effectively. And so this is one of the things that I really would wish people on both sides would think about, because there is, on the polls, you do hear people saying things like, oh, there's civil wars coming. And they seem pretty, they seem kind of accepting and sanguine about that. I mean, Rush Limbaugh, was, I think, basically, saying that would be a good thing. And it would be horrible. In a scenario in which outcomes like that are being contemplated, if not occurring, what are we looking at? I would think we'd be looking at a death spiral of the U.S. dollar, markets across the world grinding to a halt. But I'm curious, maybe you have a view on my thinking here as to if we had that sort of election outcome where, it's really perceived as just an overturning of the voters' will. Maybe you don't agree that the blue states would go that far, but, what do you think would be the market outcomes there? And how would one hedge? Right? How would one position if you were worried about that? And when do you think you should position? Which I guess is really a question of when do you think this starts to get priced in?
For me, the voting system, the vote is like the market price. It cannot be contested. It is what it is, right? And if you take legitimacy away from the vote, you take legitimacy away from market prices, and you create anarchy, both politically but financially. That is the path of descent which the Weimar Republic took in 2122. And remember, that was at the time the most divided society that we knew. everyone had turned in on themselves and hated their fellow citizens. So I don't think you need to get to the point of blue states enacting whatever forms of legislation. It is simply, if we open ourselves up to an environment, like if the previous election had been overturned, then it's goodbye capital markets. But it wasn't, and most likely these events, whilst dramatic and entertaining, it's like playing battleships. Is these are parlor games and best left in parlors and not on trading floors. The other thing is this craven desire to own these riskless assets, which also at the same time these zero coupon bonds, which are very influenced by future rates of inflation. I have been engaged as a participant and thinker in capital markets for way longer than I care to remember, and I find it very difficult to understand how inflation can foster, and I say that in the sense that all of the historic periods that I was, and I'm guilty as charged, talking about events from the 1920s. And what that is to deny is the sheer magnitude of capital markets today. The treasury market is almost 3x US GDP. And then, of course, when you throw in the corporate debt and everything on top of it, it's a big X times GDP. And if you have to reprice that, the capital destruction just takes you very quickly into a profoundly deflationary environment. You were talking about, the dollar would be toast. Versus what? Sure, versus things in limited supply. I don't want to put on the dark cloak and start talking about gold, but the precious metals complex. These electronic open ledgers that everyone is very keen on today, despite my profound weakness or inability to actually understand how this kind of chokehold that the size of capital markets have and where they're priced just now, whereby if you were to price it into even a modestly inflationary environment, the uptick in the repricing of those markets. And because any repricing is magnified like 4, 5, 6 times by the sheer size of those markets versus incomes, how you evade deflation actually achieve inflation. So that I literally cannot solve for that today. But were I to say, hey, listen, maybe solving that is above my pay grade. I spend all my time kind of surfing in the French Caribbean, so maybe there are people better placed to solve that, and they have. But your question was, defend yourself against that. Take that out of the equation. It's variance swaps. Anarchy means volatility. It means we have one-sided volatility in equity markets. Only in equity markets, things kind of gradually kind of grind higher, but they come down very hard. And there are smarter vol traders than me to tell you that that's just odd. And it's kind of something that kind of really became more noticeable after the shock crash of 1987, October 1987. There's no good reason. And so anarchy, I want to say, is where vol becomes symmetrical and you get lots of upside vol. And so, profoundly out of the money call options on US indices, which, remember, all of those contracts are all underwritten by the platform, which is to say they're all underwritten by the US government. And you're going to get paid out. So profoundly silly strikes on variance. I remember, when was it? I want to say maybe 2007. I bought a 40,000 strike on the Nikkei. I was changing at the time, my child was very much a baby, and there was profound green poo squirting everywhere about 3 o'clock in the morning. And of course, I was, what do you do in those circumstances? You trade Tokyo if you're in London. And I was buying 40,000 strikes on Nikkei. And the guy's like, what? And a trade like that, whatever you spend, whatever basis points, not percentage points, they get marked to zero. it's an investment that you make which gets marked to zero as soon as it hits your book. So my strategy would be that for every gain that I was making in these celestial calendar years, I would be deferring like 10 basis points for those calendar year gains, and I would be buying those variance swaps on US indices at very high strike prices.
But, maybe this is too tinfoil hat of a question, but I mean, would you want to hedge the currency? Because if you're going to get paid out in dollars on your swaps, would you rather be paid out in something else?
You tell me what.
JPY, CHF.
CHF the Swiss are going to end up the largest shareholder in Apple. They are. We have laughed and giggled and poured scorn on the Swiss central bank, but it has shown that with the advent of digital currencies, you can control the upside appreciation in your currency by having ledger movements which have a huge amount of zeros attached to them, and you buy dollar assets and you sell your currency. So I have failings in my logic circuitry whereby I cannot see how the chokehold of the size of capital markets priced for kind of no inflation, how that can just simply result in deflationary outcomes. I can see how it doesn't. Likewise, I really struggle to see how any other currency in the world would allow, because it would have to be a currency that allows itself, where the political class takes the decision to have a higher currency value, and that would simply, we've left that. The 1930s, the mess, the generational loss of lives and incomes in the 1930s. The only good thing which came from that mess was that we destroyed the pathology of those in monetary power at central banks. We took away their ability to have these. We're pursuing a philosophy. Back then it was the philosophy of hard money. If we go back to the 1890s when we had I don't want to call it similar, but I want to call it similar in the sense that when we came out of the Civil War, the profound stoked up demand to rebuild the American economy hit a logjam like 6, 7, 8 years later when US banks needed the collateral of physical gold to make more loans, but found themselves like the larder was empty. There was no more kind of physical gold for them to underwrite more loans, regardless of the productivity of those loans. The system was predicated to the sanctity of the solidity of gold. William Jennings Bryan and the whole Wizard of Oz thing, the populist challenger to the presidency twice in the 1890s. We're suffering under this cross of gold. People are losing their livelihood under this philosophy of a few wise men to protecting the value of this silly piece of metal. So that's all gone. Devastation of the 30s has rendered that to the past, and I can't see a society that would be willing to subjugate its democracy to the strains of allowing its currency to rise.